Talk about Nigeria's latest economic data. Not encouraging. Headline inflation nearing 20%, unemployment 33.3%, foreign trade deficit a whopping 7.3 trillion naira as at the end of last year. The question is, how should investors trade these sobering and disappointing economic reports, and what options lay before the central bank at its monetary policy meeting next week, Monday and Tuesday? Let's dig down for some answers as we bring on Ayorinde Akinloye. He is an associate investment research analyst at United Capital Group here in Lagos. Good evening, my friend.
Good evening, Boston.
Yeah, it's good to see you.
Thank you so
much. So what are you analysts at? What's your views at United Capital regarding some of these very latest sobering economic data, inflation, unemployment, foreign trade deficit? What are you folks making of it?
Okay, yeah, so basically looking across the various macroeconomic data that we've had over the past few days, I mean, we've had a rush of some of them. So basically starting with the foreign trade data, we saw the fact that total trade merchandise declined year on year for 2020, although we had a decent rebound in Q4, clearly, reflecting the fact that economic activities improved in Q4, and we had stronger oil production and stronger oil prices, which supported the oil exports, basically. We also had the unemployment reports, that came out yes, and day before yesterday, sorry, and unemployment printed at about 3.3%. We had the inflation data that came in also yesterday morning, climbing to above about 17%, basically. So clearly, our views, basically in terms of the drivers for the trade, on the side of trade merchandise, clearly reflects the fact that we had significant decline in oil exports, reflecting, lower oil prices, reflecting lower oil production under the OPEC plus production quota. So as a result of the decline in oil exports, we saw that total decline in exports out of Nigeria. Also, but in terms of imports, we saw a growth in imports, basically, for the trade data. So the decline in total trade merchandise was actually driven by the exports, basically. For inflation, definitely, we saw the fact that food index continued to accelerate. The food index continued to accelerate, basically, in February, and that was largely because of supply-side pressures on food prices. Before, we observed the fact that on a month-on-month basis, the food sub-index had been decelerating for about 2 months, but then we saw, a sort of sharp rise in February, and we think that was largely, due to the food blockade issues that we had between the North and the South during the month, and that sort of fed into pushing prices higher because of the pressure on supply. Also, we still continue to have the security challenges in key food producing states like in the Middle Belt and in the North, and those issues still continue to affect farm productivity. And then largely we also look at the fact that we are currently within the planting season. So all those factors combining together have been sort of dragging on food supplies. Then also for the core sub-index, basically, we continue to see the impact of FX devaluations, basically on general price level. So those are some of the key things that we saw drive inflation. For unemployment, clearly, the fact that we had the COVID issues last year, which led to significant loss of jobs and wage cuts across different sectors in the country. We are yet to recover fully from that slump, basically. And, we are seeing the impact on unemployment data. We saw it, it climbed to 33.3% for Q4 as at the end of Q4 2020. So those are the key things that, we highlighted as the key drivers of the negative economic.
Okay, so are there implications, my friend Ayorinde, are there implications of this core economic data on the market, both on the equity side of the street and the fixed income side?
So basically, trading from a strategic point of view, we look at the facts, picking inflation first, although we note the fact that there's been a significant divergence between macroeconomic realities and the fixed income market. Last year, we saw increased risk macroeconomic-wise, and fixed income yields were still declining. But with inflation, rising, that further gives investors more impetus to demand for higher yields, because it means, the yield curve basically continues to, fall deeper into negative territory. So that definitely implies that we might continue to see the yield environment remaining pressured. So we might continue to see yields climb higher between now and over the next couple of
Francis.
Okay. Just a quick one.
For the equity.
Yeah, okay. I'll touch on equity very quickly, and then we're going to ask the question about how investors should react to this poor economic data, Ayorinde, whether local or foreign.
Okay, yeah. So quickly for the equities market, we think the impact on the equities markets will be sector-based. For example, for the trade data, we saw the reason why the trade data declined was because of the export issues. So looking at the fact that oil prices and oil production will recover, so that will be positive for stocks within the oil sector. But for inflation and the trade deficit issue that we've had signifies the fact that
3, 2, 1 testing. Can you
affect FX pressures, because the CBN definitely will have to continue to finance this deficit, although we expect some reduced pressure in terms of the deficit over the next couple of months. So, but with the pressure still there and FX continue to remain something hard by for most of these companies to come across, then we think that we'll continue to experience significant cost pressures, particularly in the consumer goods space, and that will definitely tighten their margins. So we expect to see pressures for consumer goods stocks. For banking stocks, they will definitely benefit from the rising yield environment. So for banks that are able to balance their asset and liabilities clearly in terms of, improving their asset yield and keeping their cost of funds under control, definitely they will see the impact of rising yields support net interest margin and consequently profitability.
Okay,
in terms of trade, okay.
Yes, so just a quick one. I want us to touch on this before we wrap it up. The economic numbers will be on the table for the Central Bank Monetary Policy meeting on Monday and Tuesday. I'm sure you analysts are already looking forward to that. How do you think the committee will decide on interest rate direction?
Okay, yeah, so basically, we're still looking at the fact that the CBN will continue to maintain status quo for now, largely because the key focus for the CBN, is to still support growth and at the same time take care of, sort of manage the FX conundrum that we're currently facing. But if we look at the body language of the CBN, it has sought to use alternative means, such as, trying to target the remittance market, to boost FX inflows, basically, and also using the OMO window to attract more FPI inflows. So we don't expect them to go hawkish, in the hope of trying to attract more foreign FX inflows. Rather, they will continue to use the other segmented means, such as the remittance market and the OMO market. And also in terms of growth, we haven't seen the full impact of the past policies in terms of economic growth. Growth is still very tepid. That in Q4 we had growth of about 0.11%. So we think they still give room for growth for these policies to impact and permit the economy largely over the next quarter. So we think they will definitely maintain a goal for now.
We appreciate your insight on the show tonight. Ayorinde Akinloye of United Capital Group. Thank you so much. Have a great evening.